Hello and welcome to a CMS Forex daily video recap. I'm your fundamental market analyst, Nick Nassat. Today is Friday, June 18, 2010. It was a quiet day for the euro-dollar pair, which was unable to move above yesterday's highs, or at least just tested them at the 1.2415 level, and then fell down to retest its level of resistance, now turned support at the 1.2350 level, which also matched up with a 50-period moving average and an upward sloping line of support. Still, the euro is headed for its biggest weekly gain against the greenback in more than a year as stock markets gained and concerned over Europe's debt crisis eased this week. We saw increased demand yesterday at a Spanish bond sale and an agreement by European Union leaders to disclose how banks perform on stress tests, which damped investor concerns about the region's financial system. We'll see if this momentum for the euro continues when we come back from the weekend. We did have some fundamental releases coming out from the UK, so let's take a look at those. First up, UK mortgage approvals rose in the month of May, as the number of loans granted was at 51,000 compared with 48,000 in April, according to a preliminary reading of the central bank's panel of 6 major lenders released today. While interest rates are at a record low, banks have tightened lending conditions, making it harder for homebuyers to get loans. So this data comes as a positive for lending in the country. While mortgage approvals have stabilized as the UK economy resumed expansion, they are still at half the levels they were at the peak of the housing boom. A separate report from the Bank of England today showed that the M4 money supply, the broadest measure of money supply, was unchanged in May from the previous month, and from a year earlier, M4 growth was at 2.8%, down from 3.2%, and also the lowest level since April of 1993. That confirms some of the comments Bank of England Governor Mervyn King had earlier in the week, in which he said that the current high inflation does not symbol persistent inflation, as figures such as money supply are not showing elevated readings. In a third report, public sector net borrowing came in at £16 billion, down from £17.4 billion a year earlier this month during May, and below forecasts of an £18 billion number. April's borrowing figures were also revised down by £1.6 billion. The UK's net debt stood at £903 billion, up from £774 billion a year earlier, the equivalent of 62.2% of the UK's entire annual economic output, or GDP. The big picture, of course, is that borrowing remains extremely high, and additional measures to reduce the deficit will be required and will be presented in next week's budget. We expect tax rises and spending cuts adding up to perhaps £20 billion per year to be announced next Tuesday. Britain's new finance minister, George Osborne, is keen to act due to the recent turmoil across Europe amid fears of a Greek default and worries over the strength of Portugal and Spain. Pressure for accelerated fiscal tightening in the UK is being maintained by countries across the Eurozone stepping up their austerity measures in reaction to the region's sovereign debt crisis. Taking a look at the pound-dollar pair, we see that in overnight trading, the pound actually rose on the better-than-expected public borrowing and mortgage approvals data, hitting a new high for the week at 1.4885, but it retreated in the late European session and in New York trading to retest this 50-period moving average on the 1-hour time frame, but also the psychologically important 1.48 level. The pound also seems ready to hold its gains that it had following the dip in the middle of the week following those comments I had just mentioned by Mervyn King, which came here in the middle of the week. Also from the UK, we did have some better retail sales data that came out yesterday, so fundamental data was rather supportive of the pound, at least in this week's trade. Zooming this pair out to show more price action, we see that we're in this upward sloping channel and we keep running up against the upward boundary of that channel, which is holding as resistance. We also have this upward sloping level of support, which will be important to monitor in the beginning of next week's trading to see if we try to test it and then possibly break it. On the upside, we have the 1.5050 level as our next key level of visual resistance in the pair. On a Friday, when things were relatively quiet and there was little sense of urgency in financial markets, with European sovereign debt fears simmering down and spreads between Spanish and German bonds having contracted sharply ahead of the weekend, and with European stock markets mixed and US markets higher on the day, with the dollar steady, there really was only one market that stood out, and that was gold. We see following the rise in gold yesterday that we surged ahead again in today's trading with the gold contract for August delivery rising 0.8% to settle at 1,258, which was a new record high. Here in our gold dollar pair, we hit a high of 1,262, and we see that that was the highest we had been in this pair as well. It could be that investors are tired of their 0% T-bills, afraid of the stock market as they may fear double-dip recession, and people are pouring into gold even despite its very high levels right now. So gold bugs did seem to feel a sense of urgency, and perhaps they feel that there will be some more negative developments coming up in terms of sovereign debt as we come back from the weekend, or at least during the next few weeks. Turning back to some more fundamental news, we had Canada's Index of Leading Economic Indicators come out today for the month of May, and it showed a 12th straight monthly increase as opposed to the 0.9% increase, a little bit better than forecast and matching April's figure. Canada's economy emerged from its slump last year at a faster pace than the Bank of Canada has anticipated, with GDP growing 6.1% at an annualized pace in the first quarter. Within the leading indicators, new orders for manufacturers led gains, rising 4% from the previous month. We also had the ratio of factory shipments to inventory strengthen for a 10th consecutive month, while the average work week grew by 0.3%, rising for the first time since September. However, on the downside, we had the housing index, a composite of housing starts and existing home sales, fall by 1.2%. In a second release from Canada, foreigners resumed their substantial purchases of Canadian securities in April, increasing their holdings by 12.4 billion Canadian dollars. That had followed selling by foreigners of 638 million Canadian dollars in March. Foreign investment in Canadian bonds in April was at 10 billion Canadian dollars, a very strong amount, and as we can see, following a weak amount in March, we're back to the levels we had seen the previous 4 months. That reinforces the positive perception of Canada right now, and since it has a current account surplus and trade balance that is positive, foreign investors are looking at Canadian bonds as a much safer investment compared to some of the other debt-strapped nations of the world. The US dollar Canadian dollar pair, which had tested this 1.020 level 3 times earlier this week, finally managed to move below it in late New York trading as we came close to closing out the week. We can also see that we have a downward sloping level of resistance, so if we break out on the bottom in a strong way when we come back from the weekend, that could see that this pair falling further. And if we zoom out, we see that the 1.01 level would be a target for the down move. As I had shown with gold prices rising today, the Australian dollar-US dollar pair moved higher today as well, supported by the higher commodities, and broke above this 0.8680 level, which had acted as resistance throughout most of the week, and though we moved above it in late trading yesterday, and then retested this level as support, and we are going to actually close higher at around the 0.87 level. So while the euro did give up a small part of its gains in today's trading, we did see the commodity currencies rising to end the week. So those were our highlights and key fundamentals from today's session. Let's see what the fundamental docket holds for next week. From the US, we're going to get data on existing home sales as well as new home sales. So we'll see what the expiration of the homebuyer tax credit, what the effect will be on the US housing market. Also, on Wednesday, we will get the FOMC interest rate decision and the statement, which will be key for market direction in the middle of the week. Also, important releases to look out for will be the Richmond Manufacturing Index on Tuesday, as well as durable goods orders on Thursday, our weekly jobless claims, and then on Friday we get the final version of GDP, which isn't expected to change from its second version, and the final version of the UMich Consumer Confidence. Around the world, we start off Sunday with the UK Rightmove House Price Index. That's followed by the German IFO Business Climate Index and Canadian Consumer Prices on Tuesday, and the aforementioned UK Annual Budget. On Wednesday, we get more data from Canada in the form of retail sales, and the end of the week will hold key releases for New Zealand, including its GDP as well as trade balance. So that will wrap up our coverage of the Forex market for this week. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you good trading.